Hello, this is Arthur Hill, Senior Technical Analyst with StockCharts.com, and you are tuned in to On Trend. Thanks very much for tuning in. I'd like to take this moment to welcome our producer, Zach Dillon, to the show. Zach?
How's it going, Arthur?
Very good, very good. Beautiful spring day. We got the sun out, so maybe going to hit some tennis balls tonight.
Oh, that sounds like fun. Awesome.
Yeah.
Well, hey, let's go ahead and pull up that browser really quick, and let's go show people how they can ask you questions for the end of the show. As you guys see over on the right-hand side, we have Stock Charts TV questions and polls. There's a poll that's running, so you can answer any of the questions that that Arthur has put in to the polling. And then as far as questions, Arthur's going to be fielding some questions at the end of the show, so be sure to write some of those questions in so that we have something to ask him at the end. So other than that, Arthur, it's yours. Go for it.
Very good. Thanks very much, Zach. So here's what we're going to talk about today. We're going to go over the 200-day cross. And those who tuned in last week will remember I went over that for the S&P 500 and SPY. And today we're going to apply it to these other four ETFs. And then we'll see if we can get better signals using signals from the S&P 500. Then I'm going to show you how to measure relative chart performance. And this means you can look at one chart for your benchmark, get your key levels, and then compare those to other benchmark levels on other charts. And I'll go over some current market analysis as well. So we're going to start off with the S&P 500, the DIA, the Dow Diamonds, and QQQ. Now from last week, this is the chart showing the 5-day SMA or the S&P 500 and the 200-day SMA. And the S&P 500 itself is invisible. So I'm just focusing on these moving average crossovers. And I did a back test, and there were 66 crosses in 25 years. And kind of a 67th if you count this beginning when it was already above the 5-day SMA was above the 200-day. And if you run the numbers, you can see that the compound annual return was 7.6%, and the drawdown was around 20%. So I'm going to take this a step further now and see if we can use S&P 500 signals on QQQ, DIA, IJR, and MDY. And the first up is QQQ, and I'm comparing the 5-day SMA for the S&P 500 with QQQ. Now, yeah, I'm cherry picking a whipsaw, but this is the idea to see. I'm going to crunch all the numbers in a minute and show you some tables to see how that performance stacked up. But you can see here in 2016, when the moving average cross for the S&P 500, it stayed above. And QQQ, which is a little bit more volatile and was a little bit weaker at the time, dipped back below its 5-day SMA a couple times. So you got some whipsaws there. But since then, both have been riding above that 200-day SMA. Now here is IJR, the small cap iShares. And small caps, of course, are a little bit more volatile than large caps. And if you'll recall last week, I basically made the case that the S&P 500 is really the only index that we need to analyze. It is the benchmark, and we can just say if the S&P 500 is in a bull market, that's good enough for the rest of the market. So look at the S&P 500 versus IJR. You can see IJR crossed below, that 5-day SMA crossed below in August, right? Whereas the S&P 500 stayed above. And that didn't break the market. Relative weakness, the small caps were relatively weak all during this period, but that didn't break the market. The S&P 500 continued higher. And as long as the S&P 500 does well, we're all right as far as the market is concerned, the broad market environment. So let's put some numbers to it. Now, don't glaze over here because I'm going to show some tables. They're very simple tables. I'm just testing from June 2001 to March 31st, 2018. Got to go by quarters. And I started in June 2001 because that's the first date I could get a full test for IJR. But you can see this is SPY with DIA. And you can see that if you use SPY with the S&P 500 for signals, the 5-day crossing above and below the 200-day SMA for your signals, you got 5.88% compound annual return. Now, we had 2 bear markets in that period, so that's why it's lower. And you can see DIA, if you use DIA for signals, you got a 4.45% return, which is lower. But if you use those SPX symbol signals applied to DIA, you had a higher return, 6.11%. And then you can see the drawdown was less. Again, using the S&P 500 for the signals and buying and selling DIA, the Dow Diamonds. Now for the next one, got to go back. I think we skipped one. We're going to do QQQ. So here's QQQ, and if you're using QQQ for the signals, the 5-day crossing above and below the 200-day, you got a 5.08% compound annual return. But if you used S&P 500 for the signals and bought QQQ when the S&P 500 triggered a bullish signal, sold QQQ when the S&P 500 triggered a bearish signal, you got a higher return, about 50% higher, 7.41%. And look, the drawdown was less. And the winning percent was higher. You had more winners than losers. So it pays to watch the S&P 500 for signals on QQQ more than watching QQQ for signals. Look at MDY, a similar scenario. If you use the 5-day, 200-day crossover for MDY, you had a 6.26% annual return. But if you use the signals for the S&P 500 and bought or sold MDY, the mid-cap ETF, you had an 8.24% annual return. That's like a third higher. Your drawdown was lower and your winning percent was higher. And finally, with IJR, the small cap ETF. So if you used IJR for the signals, you had a 5.56% annual return. But if you used the S&P 500 for the signals, you got an 8.25% annual return. And the drawdown was less and the winning percent was higher. So if we go back to this chart here, so instead of, using IJR for your signals and selling here and buying here, you would just use the S&P 500 for your signals and you would turn out better. Now, keep in mind that these long-term moving averages, they're really not buy-sell signals because not everybody just loads up when you get this moving average crossover and holds. I mean, you've got cash coming in throughout this uptrend that you need to do something with. All right, but when the S&P 500 is in an uptrend, that tells you basically, are we in a bearish market regime or in a bearish market regime? And right now we're in a bullish market regime. You can see the 5-day SMA came down, almost tested that 200-day, didn't quite get to it. But as long as it remains above, we have to think we're in a bullish bull market, and we would expect positive resolutions to most chart patterns. All right, now I want to talk about identifying levels to benchmark. And this is what I use when I look at charts and I'm trying to find out which charts show relative chart strength and which show relative chart weakness. And the first thing you have to do is get your benchmark. And you don't get any prizes for guessing what I'm going to choose for the benchmark. It's going to be the S&P 500. You can use SPY if you want. You can use the E-mini. Of course, that rolls over and changes, but I just prefer to use the S&P 500 as my benchmark. So I've set 2 benchmark levels that I want to compare when I'm looking at other charts. So you can see this January high here. And I went back, so I'm going to have to, there we go. There's that January high. So that's my first benchmark high. And you can see when the S&P 500 rallied here, it didn't get close to that January high. About 3% below it, it remained. And then when the S&P 500 declined, it moved all the way back to that February low. So that's the benchmark low I'm comparing, and this is the benchmark high I'm comparing. So if we move forward and we look at small caps, IJR here, we've got that benchmark high in January. Well, small caps almost hit that high. So they had a stronger rally from February to March. And then when small caps declined, they held above this benchmark low. So they held up much better during the decline. And so that tells me that small caps are showing chart strength. There's also one more thing I would like to talk about on that SPY chart or S&P 500 chart. You can see RSI dipped below 30 here in February and again in March. And then if we look at IJR, it dipped below 30 in February, but held above 30 in March. So that just showed less downside momentum on the decline. And that was another signal that small caps were holding up better than large caps.
Hey, Arthur, really quickly, Roy just wanted to have a quick refresher. What is a drawdown that you're referring to? I think it was a couple of slides back, but just...
Sure. That's a good question. Drawdown is basically, if you see here, I was running this test from 2000. So if you had been buying and selling and you had, I think IJR had a string of like 8 consecutive losses at one point. And so it had a very steep drawdown, and that's the drawdown in the value of your portfolio. So if you're running a portfolio and your portfolio value goes up to 100,000 and then you hit some bad trades and it goes down to 60,000, that would be a 40% drawdown in your portfolio.
All right. Thank you very much.
Yeah, you're welcome. All right. So speaking of these benchmark levels, I was looking at some sectors, and I noticed that these small cap sectors are performing quite well, better than any of the large cap sectors. Here is the small cap consumer discretionary sector. And you can see that February low, and it did get down and test that February low pretty much. So, we didn't have a lot of relative strength there on that dip. But look, this is one of the few sectors to break above that February, March high. So it's showing some relative strength. And I'm also seeing some strength in retail. And I have a feeling there are a few retailers in that small cap sector. We also have small cap healthcare here. And look at this. It hit a 52-week high in early March, and it's at a 52-week high now. So here you had the February low, didn't even get close to it, over 7% above it, and it's already at a 52-week high. This is one of the strongest sectors in the market, small cap healthcare. And then when we look at industrials, we're seeing strength in industrials on the small cap basis. And I'll look at the sector SPDRs in a little bit. That's part of our poll question, and we'll see which one I think is the strongest. Place your bets. So you can see there's an uptrend here. And when the S&P 500 was below its February or January high, the small cap industrial sector was hitting a 52-week high. That is chart strength. All right. And then on this dip, it held well above that benchmark low, that February low. Again, chart strength. And now it looks like it's on its way to a new 52-week high. So this is a good time to move into the current analysis. And to do that, I'm going to switch over to a browser so we can look at some charts. And I need to move over to a different tab here. So here's the S&P 500 as represented by SPY and the E-mini. And we can see that we've basically been swinging down, up, down, and we've been swinging up now for about 2 weeks. And the S&P 500 SPDR here was one of the IJR had already broken above this high here. This is kind of a benchmark high here from late March to early April. And there you can see that breakout there that we're getting over the last 2 days. So a nice little breakout there. We definitely got an upswing going here. And for first support, I'll just keep it a little loose. We got this gap that started here about a week and a half ago. And as long as that gap holds at 261, I'll keep a bullish bias on SPY. And remember, 50 days above the 200-day, 5 days above the 200-day, it's still a bull market. Excuse me there. I'm going to go back. I thought I was on the PowerPoint still, so I was clicking. So here's the small cap SPDR, IJR. And it's been showing relative strength for quite a while. And if you look at this pattern here, there's a big dip, and you challenge that high. You have another dip, and we broke out here, and that looks like a cup with handle taking shape. And that was a pattern that was popularized by William O'Neill of Investors Business Daily. In fact, the CMT Association had their annual symposium Thursday, Friday last week, and William O'Neill was given the annual service award for his contributions to technical analysis. And if you hadn't read any of his books, I would suggest you get your hands on them because he was one of the pioneers for combining relative strength with fundamental analysis and technical analysis. But looking at this pattern here, it's a bullish continuation pattern, and a breakout there above these highs would confirm it. Now, I'm not a big fan of price targets. You know, you can measure the distance from 72 to 80 and tack on another 8 to get a price target of 88. That's the traditional way. And as far as I'm concerned, the cup with handle is secondary to what's immediately happening on this chart. I mean, you're in a long-term uptrend. Now, you had a 52-week high here. You challenge that high. You had this pullback right here in March, April, and now there's the breakout. That's the important thing happening right here, this breakout that we had at 78. Sure, we fell back, but we're back above it, and it looks like IJR is headed to new highs. In the indicator window, you got the price relative, which is the IJR SPY ratio, and it's been rising since early March. So that tells you that small caps are outperforming large caps. So here's retail XRT. Now, it's not one of the strongest ones, but when I look at this chart and when I talk about being on trend, the first thing I do is I look at one-year charts basically, and I say, is the trend up or down? And if I see a 52-week high within the last few months, and there's a big breakout, and most of the action is going from the left to the upper right, I think it's an uptrend. And this is a big 30% advance. And after a big advance like that, you got to expect some sort of a correction. And this decline here from January, well, actually, it ended in February, and we tested that low here, but it retraced around 50%, about half of the prior advance, which is pretty normal for a correction. And XRT here was one of the first to break out. So this is a positive development for retail. I think it's breaking out and ready to move higher here. Moving on to the next page. Got the broker-dealer iShares. Now, the finance sector struggled a little bit over the last few weeks, and this one has too. I'm still bullish because there's a clear uptrend here. Had a nice sharp decline to the support zone, upper end of that support zone, and starting to work our way higher. I could draw a little wedge or a pennant and say that's bearish, but when the bigger trend is up, I tend to ignore short-term bearish patterns. All right, you got to be focused on patterns that are in harmony with the bigger trend, and I think that bigger trend is up. So I'd be more focused on the fact that we're edging above resistance. I'd like it to be a little stronger, but maybe we'll get a catalyst in the coming days. Maybe we'll get a good report from Schwab. I have no idea how they're going to report, but it is earnings season. Here's regional banks, and they are struggling as well, KRE, but the overall trend here is up, and you came down pretty hard, consolidated, and it looked like we were getting a breakout, but then fell back. So This is a bit negative here, but haven't totally broken down. You have to break below 58 to, fully reverse this uptrend here that's been going on. And I suspect that the interest rate environment over the last few weeks, because interest rates have been falling, and I'm going to get to the 10-year Treasury yield in a little bit to see how that might affect. This has been one of my favorite groups, Aerospace and Defense. There you can see that low in February. It held above the low on this pullback, kind of a wedge taking shape and getting a nice breakout today. But this was expected, because the long-term trend is up and you expect a trend in motion to stay in motion. So I expected a breakout here just because I assumed that the long-term trend was up. That's not a very brash assumption if you look at the lower left and then compare it to the upper right. Healthcare providers are getting a nice move over the last 2 days. And by the way, all these charts are featured in my weekly market review and outlook on Fridays. That's a subscription only part of stock charts, but I do a video on Friday and I cover about 30 industry group ETFs, and these are included. But if we look at this one here, the long-term trend is up, 52-week high after a massive surge. So that tells me I want to have a bullish bias when I'm looking at this chart. And so we got this triangle. That's a consolidation within an uptrend. And then within the triangle, you got swings down, up, down, and now we're turning back up. So healthcare providers are getting back in favor. Medical devices, another one that is looking good. I have a feeling a lot of the stocks in this medical devices ETF are probably going to be found in small caps. A few of them are going to be large caps. Medtronic, there you can see around 10% of the ETF. But a nice surge back to that January high. It held above the February low on the pullback and getting a breakout. So I would expect a new high in the foreseeable future from medical devices. Now getting to IEF. Now this is also where I want to stay on trend. What's the big trend on this chart? Is the 1 year, 3 month chart. Is it up or is it down? Well, I'm going to vote for down. You had this wedge break here. You had the big support break in December. And then if you look at the TLT, the 20-plus year Treasury bond ETF, you had a big head and shoulders form and a breakdown there. So I think the bigger trend is down, and I've got a bearish bias on this chart. So I'm not looking for like bullish setups. I'm looking for maybe a bearish continuation pattern. And these blue lines I've drawn represent what I call like a sloppy channel or sloppy flag. I mean, these prices aren't perfect. We don't get perfectly parallel channels or flags or nice wedges or pennants. Sometimes you get spikes below and spikes above. But I think the gist of this pattern is it's a counter trend advance. So you came down so hard here, and same with TLT, very sharp decline. And now we're having a counter trend move. And at some point, I'm expecting a break and a continuation lower in Treasury bonds. And, perhaps when that happens, we'll see finance get its bid back. Oops, accidentally clicked on that. I'm going to go back one. And here's the 10-year yield and the 30-year yield. And of course, they go opposite of those two that I just showed. Here's T and X. And massive advance from 2.1%, which is 21 on the chart here, to 2.9%. And now we're kind of just correcting a little bit. And we need to get a breakout at 29 to continue the move up in Treasury yields. And there's the 30-year. And we need to get a move above 3.1% to continue the move in Treasury yields. But this decline in yields has helped utilities and REITs. But also with utilities and REITs, I think they're within a counter trend move. So that brings us to the question and answer part of our show. Zach, you got anything?
Yeah, it's been really, really quiet in the chat box over here. Just wanted to remind everybody, ask your questions. Last week we had a flood of questions come in at this time, and kind of hard to manage at that point. But I had a question for you. So we had Carl Swendlin on the show on Market Watchers last week. And he was talking about the S&P, and he was talking about, parabolics and whatnot. And he is facing more bearish towards the market. What are your, and obviously he takes a longer look at the market as well. So I was just curious on your thoughts on that one.
Well, I am still bullish on the market. And if you look at this chart here, sure, we've had a decline, but we're still, the 5-day SMA is above the 200-day. And I did a chart and I showed 3 different moving averages. And basically the 5-day moving average, the 25-day moving average, and the 50-day moving average. And you kind of use that as 3 strikes and you're out. I'm more of a trend follower. And so until we start seeing some breaks below that 200-day in the 5-day, the 25-day, the 50-day, I don't see a bear market yet.
Yeah, awesome. And also, just to clarify, Carl did say he wasn't saying that we are in a bear market right now. He was saying that he was seeing the signs for a bear market. So I don't want to put words in his mouth.
Yes.
That are not supposed to be there. But other than that, we probably could comment a little bit about the poll and anything else that you had to go ahead and wrap up before we close off the show.
Somebody was asking me how I created those charts. Am I getting echo on you?
Yeah, no, that was me. That's our the system's speaking over itself. But we actually got a question in. Dave was saying, why do you think that banks are not moving up on good earnings?
I have no idea on earnings. I think that I showed the treasury yield chart, and that's my opinion of if I'm looking for a reason, that would be the reason,
okay.
The treasury yields.
And then the last one, current breakout, SPX at 2,700 QQQs, etc. Meaning right now today, thoughts on breakouts above the 20-day moving average?
I don't use moving averages as resistance. I only use them as a broad trend identification. When I use the price. And so I'm just looking at the price levels and not so much the moving averages. I can show that chart again. There we go. Yeah, I just use the moving averages as a broad trend identification tool. And for the rest, I'm using the price chart. So I don't need a 20-day to help me on this chart. There's a clear resistance level there, and it's clearly broken. So that's why I would just focus on the chart.
Awesome.
So yeah, somebody was asking about how I created this chart. If you go down, I've got the S&P 500 for the symbol, and I've got invisible for the chart type there. And so that kind of hides it. And then you can focus on your 2 moving averages. And then you can see here, I've got IJR as invisible, and you can focus on those 2 moving averages. So that would conclude our show today. I'd like to thank everybody for tuning in. And just remember that we'll be on again next week. And remember to stay on trend.